Hi, my name is Kevin Chang, and I'm a managing director at Aries Management, where I focus on infrastructure secondaries investing. Aries is one of the largest global asset managers with over 30 offices worldwide, more than 2,600 employees, and 360 billion in asset under management. We operate an integrated platform across multiple business groups, including secondaries, credit, private equity, and real assets. Our goal within the infrastructure secondary platform is to provide limited partners with low risk exposure to the private infrastructure asset class. We do this by being a liquidity solution provider and thought partner to both the LPs and GPs while seeking attractive risk adjusted returns to our investors. As investors evaluate asset class in this environment, infrastructure provides some unique benefits. First, it provides near-term cash yield. Second, it provides diversification into less correlated industries. Third, it provides inflation protection. And finally, it provides an opportunity for alpha generation through market inefficiencies. As of year-end 2022, based on Preqin and infrastructure investor data points, infrastructure remains one of the fastest growing sectors in private markets, with aggregate capital increasing from $30 billion in 2011 to $170 billion last year in 2022. That's a compounded annual growth rate of 17%. The breadth of available private infrastructure fund offering continues to increase, with 90 different distinct fund options available last year. As a result of this growth, we have seen the average infrastructure fund triple in size since 2016, from $600 million to $1.8 billion. Seeing primary infrastructure GPs raising north of $15 billion per fund is the new norm, and a validation of the continuous demand for the asset class. Secondary infrastructure is a newer but growing asset class that plays an important role for institutional investors. Investors in infrastructure secondary seeks to accelerate the traditional benefit of direct infrastructure exposure, including current yield and inflation protection, by gaining exposure to seasoned assets poised for harvesting. They also seek immediate diversification, something that can be very difficult to achieve through a series of direct manager investments. The infrastructure asset class can be opaque, but with the right partners, tools, and insights, can offer outsized opportunities. Aries has a 14-person research team that helps shape how we and our investor partners think about portfolio constructions, what LPs and GPs seek when deploying capital, and how best to serve the broader investment community as it addresses organizational and portfolio objectives. These insights are critical as a successful infrastructure investor to create optimal portfolios that minimize risk and capture the benefit of infrastructure and optimizing returns. With the positive momentum we have experienced in the allocation to private infrastructure, the existing amount of illiquidity exposure is well over $1 trillion today. And that's a 14% compounded annual growth rate since 2012 of 400 million. This is per the data we're seeing in Preqin report as of June 2022. This level of illiquid exposure or net asset value has fueled the need for a secondary market as a necessary portfolio management tool for investors in today's fast-changing environment. There are a number of reasons why LPs are seeking liquidity, and these can range from the impact of today's denominator effect to changes in investment objectives and manager selection. The long useful life of infrastructure assets and growing opportunities around many sectors, including energy transition and digitalization, has also led to significant demand for direct infrastructure managers to partner with secondary capital as they seek to maximize value for their investors. For the past 3 years, the market has seen well over 60% of secondary infrastructure transaction volume driven by sponsors in so-called GP-leds or continuation fund opportunities, as reported by different secondary market advisors as of year-end 2022. All of this has driven a secondary market volume of 16% compounded annual growth rate since 2012 and will continue to drive opportunities going forward. One of the key parameters the secondary investment community focuses on is the turnover ratio, which is a measure of the amount of existing NAV that shows up as transaction volume in the secondary market. By comparing the total annual transaction volume to the outstanding NAV each year, we observe a turnover ratio of between 1.2% to 1.7% in normal market condition as of year-end 2022, based on the data we see in Preqin. We believe this will yield significant growth on a go-forward basis as the underlying NAV continues to swell. We estimate aggregate infrastructure secondary volume to be approximately 30 to 60 billion US dollar over the next 3 years. However, there's approximately 28 billion of secondary dry powder based on our internal views and not enough capital to address the opportunity. This implies a favorable supply and demand dynamic for thoughtful secondary investors. The infrastructure secondary market has really grown and is a dynamic space where informed players can add significant value. Aries is excited to be a thought partner in infrastructure investing community, working with both the LPs and GPs to address their portfolio management needs. We have spent significant resources building up the capabilities to lead innovation in both benchmarking and data analysis to help the investor community better understand their portfolio and achieve their organizational objectives. We will welcome the opportunity to share these insights with you.